Last year, a friend of mine got home from work on a Monday night. He didn't gamble, he didn't buy anything stupid, he didn't make some wild financial decision, he just missed a payment. $35, a small fee, the kind you barely notice. He told himself, I'll fix it next month. But next month came with interest, and the month after that came with a lower credit score. And suddenly, everything got more expensive. Insurance, even borrowing money. That's when it hit me. Why is it that one tiny mistake can follow you for years? And why does it seem to hurt people with less money so much more? My name is John, and today I want to talk about the 35 mistake that quietly keeps people broke. And on this channel, I don't talk about money from the perspective of someone who figured it all out. I talk about money the way most of us actually experience it, through bills, deadlines, small mistakes, and the quiet stress that follows us home after work. Because here's the thing, that 35 fee wasn't the real problem. The real problem is what happens after the fee. Most personal finance advice treats small mistakes like character flaws. You should have been more responsible. You should have paid attention. You should have had savings. But that explanation falls apart the moment you ask a simple question. Why do small mistakes seem to explode into massive consequences for some people, but barely register for others? Missing a payment by a few days doesn't ruin a wealthy person's life. It's an inconvenience, an email, an annoyance. But for someone living paycheck to paycheck, that same 35 mistake can trigger a chain reaction. Fees, interest, credit score damage, that quietly follows them for years. This video isn't about how to avoid mistakes altogether. That's unrealistic. Everyone misses something eventually. This video is about why the system is designed to amplify small mistakes when you don't have a financial buffer. We're going to talk about how a single 35 fee turns into long-term credit damage, why credit scores punish timing more than behavior, how being poor makes everyday financial services more expensive, and why this cycle keeps repeating even for people who work hard and try their best. Because once you see the pattern, something important changes. You stop blaming yourself for being bad with money, and you start understanding the invisible rules that shape your financial life. None of this is financial advice. I'm not telling you what to invest in or how to get rich. I just want you to understand the game you're already playing so a small mistake doesn't quietly decide your future for you. In the next part, we'll look at the first domino moment that harmless 35 fee shows up and why it always seems to arrive at the worst possible time. That 35 fee doesn't usually show up when life is calm. It shows up when your account balance is already low, when rent just went out, when groceries cost more than you expected, when your car made a noise you decided to ignore for one more week. That's not an accident. Late fees, overdraft fees, missed minimum payments, they're all designed to hit at the edge of your margin, right when you have the least room to absorb them. Think about it. If you have plenty of money, a 35 fee is annoying. You notice it, you sigh, and you move on. But if you're living paycheck to paycheck, 35 isn't just a fee. It's gas money. It's groceries. It's the difference between making it to Friday or not. And that's where the first domino falls. You don't miss payments because you're reckless. You miss them because money timing matters more than money amount. Bills don't care that your paycheck comes 2 days later. Banks don't care that your hours got cut this week. The system runs on dates, not circumstances. So the fee hits. Then something subtle happens. You tell yourself, I'll catch up next month. Not because you're irresponsible, but because you're exhausted. Because dealing with it right now feels overwhelming. Because calling customer service during work hours might cost you more than 35 in lost time. And suddenly that small fee becomes part of your balance. Now interest starts applying to money that wasn't even something you spent. This is where the system gets clever. The fee isn't meant to be catastrophic on its own. It's meant to push you just far enough off balance that the next step becomes more likely. You pay the minimum instead of the full amount. You delay another bill. You move money around to survive the month, and none of that feels dramatic. There's no explosion, no flashing warning sign, just a quiet shift from I'm okay to I'm juggling. Here's the uncomfortable truth most people don't say out loud. The financial system doesn't punish big mistakes the hardest. It punishes small mistakes made without a buffer. That 35 fee is a test. If you have savings, you pass without noticing. If you don't, the system learns something about you. It learns that you're vulnerable to timing, to fees, to interest, to escalation. And once that happens, the game changes. Because the fee itself isn't the real cost. The real cost is what it unlocks next. In the next part, we're going to talk about how that tiny moment missing a payment by a few days turns into something much bigger. A credit problem that follows you long after the 35 is forgotten. Here's the part no one explains when they talk about credit. Your credit score doesn't measure how good you are with money. It measures how predictable you are to lenders. And predictability has very little to do with effort. When that 35 fee shows up, the clock starts ticking. At first, it's just a late payment. A few days go by, then a few weeks. And somewhere along that timeline, something important happens. Your behavior gets recorded. Not your intentions, not your circumstances, just the fact that you were late. Credit systems don't see a rough month. They see a deviation. And deviations have consequences. A single missed or late payment can knock dozens of points off a credit score, sometimes more, especially if your score wasn't high to begin with. Now here's the part that feels unfair. If you have excellent credit, that drop might barely matter. You're still considered safe. You still get approved. You still get decent rates. But if your credit is already fragile, the same mistake hits harder. This is where the punishment becomes uneven. 135 mistake doesn't just lower your score. It can push you across a line, from good to fair, from fair to subprime. And once you cross that line, everything gets more expensive. Your interest rates go up. Your approvals get harder. Your deposits get higher. Your options get worse. You didn't suddenly become worse with money. You just became riskier on paper. This is how a small fee turns into a long-term problem. Not because you didn't pay eventually, you did, but because the system remembers that moment long after you've moved on. And the memory sticks. Late payments don't disappear after you fix them. They linger, sometimes for years. Meanwhile, every new decision you make gets filtered through that history. Car loan? Higher rate. Credit card? Lower limit. Insurance? More expensive. Even renting an apartment can become harder, all from a mistake that felt small at the time. This is why people feel like they're doing everything right and still falling behind. They're not stuck because they keep making bad choices. They're stuck because one mistake changed the price of every future choice. And the most frustrating part? By the time you feel the full impact, the original 35 is long gone, forgotten, paid off, but the consequences are still quietly compounding. In the next part, we're going to zoom out and look at the bigger picture, why being poor makes basic financial services more expensive, and how this 35 mistake is just one example of a much larger trap. There's a phrase economists use for this. It's called the poverty premium, and it describes one of the cruelest dynamics in personal finance. The less money you have, the more expensive everything becomes. That 35 mistake is a perfect example. Once your credit score drops, you don't just pay more in interest, you start paying more for basic access. Borrowing money costs more. Insuring your car costs more. Sometimes even your utilities require larger deposits, not because you're irresponsible, but because the system now sees you as risky, and risk is expensive. Here's where this turns into a trap. When money is tight, you don't have the luxury of optimal choices. You don't get to say, I'll wait and save. You don't get to shop for the best rate. You take what's available. A higher interest loan, a credit card with worse terms, a buy now pay later option that looks harmless but compounds quietly. This is modern day Sam Vimes' boots theory, just updated. If you're wealthy, you can afford the good boots, the low interest loan, the emergency repair, the full balance payment. If you're not, you're forced into the cheap option that costs more over time. Not because it's better, but because it's immediate. So that 35 fee doesn't just cost you money, it pushes you toward decisions that feel reasonable in the moment and are devastating in the long run. And here's the part that really messes with people's heads. From the outside, it looks like bad behavior. People say things like, why didn't they just save? Why do they keep using high-interest credit? Why don't they plan better? But those questions ignore timing. When your margin is thin, time becomes the enemy. You don't need the cheapest option, you need the fastest one. And the fastest options are almost always the most expensive. This is why people can work harder, budget tighter, and still feel like they're running in place. They're not climbing out of a hole. They're paying rent inside it. That's what the poverty premium really is. Not a single fee, not a single loan. It's 1,000 small extra costs layered on top of each other, all triggered by moments when you didn't have enough buffer. And once you're inside that system, escaping it takes more than willpower, because every step forward costs more than it should. In the next part, we're going to talk about the most invisible cost of all, the psychological trap that keeps people from stopping this cycle even when they know what's happening. By the time people realize they're stuck, the money problem has already turned into a mental one. Because here's what usually happens after that 35 mistake. You don't talk about it. You feel embarrassed, not ashamed enough to panic, but just enough to avoid it. You think, I should have known better. This is my fault. I'll fix it when things calm down. So you don't call the bank. You don't ask for the fee to be waived, even though it often could be. You don't challenge the system because deep down, you assume the system is right. And that's the trap. The financial system doesn't just charge you money. It charges you emotional energy. Calling customer service takes time. Explaining your situation takes vulnerability. Hearing there's nothing we can do feels like confirmation that you failed. So most people choose the quieter option. They pay the minimum. They move on. They tell themselves it's temporary. But avoidance has a cost. Late fees turn into balances.
Balances turn into interest. Interest turns into stress. And stress changes behavior. When you're stressed about money, you don't think long term. You think in weeks, sometimes in days. That's when expensive solutions start to look reasonable. Buy now, pay later, high interest cards, quick fixes that trade future stability for present relief. Not because people are impulsive, but because their brains are in survival mode. This is why financial advice that focuses only on discipline misses the point. The problem isn't that people don't know what they should do. The problem is that stress narrows the range of choices they feel capable of making. And once money becomes emotional, every decision feels heavier than it should. That's how a 35% mistake keeps its grip for years. Not through math alone, but through silence, shame, and exhaustion. In the next part, we're finally going to break this cycle. Well, talk about small, realistic actions that stop the domino effect early, before one mistake gets the chance to decide everything that comes after it. So how do you stop a 35 mistake from turning into a multi-year problem? Not with perfect discipline, not with complicated spreadsheets, and definitely not with guilt. You stop it by breaking the domino effect early, before the system has a chance to escalate. Let's start with the most important idea in this entire video. You don't need a big emergency fund to protect yourself. You need a small buffer at the right moment. Think of it as a shock absorber, not a safety net. For most people, that number is surprisingly low. $50, $100, sometimes even less. This isn't about being prepared for every disaster. It's about having just enough money so a timing issue doesn't become a character judgment. That small buffer does 3 things. First, it turns fees into inconveniences instead of emergencies. You pay them immediately, no interest, no follow-up damage. Second, it buys you time. Time to call, time to think, time to choose a better option. And third, it keeps your credit history clean, which quietly saves you thousands later. Now let's talk about automation, because this is where advice often goes wrong. Automation is helpful, but blind automation is dangerous when your margin is thin. If your account balance regularly drops close to zero, auto payments can backfire. They don't prevent mistakes, they just make them invisible until it's too late. A better approach is automation with guardrails. Minimum payments on auto pay, alerts when balances drop below a set number, calendar reminders before major bills hit. The goal isn't to never think about money. The goal is to catch problems while they're still cheap. Next, calling and asking for fees to be waived. This is uncomfortable, and that's exactly why it works. Most people don't call. They assume the answer will be no. They assume they don't deserve help. But many fees, especially first-time or rare ones, are negotiable. You don't need a dramatic story. You don't need to argue. You just need a script. Hi, I noticed a late fee on my account. I've been a customer for a long time, and this is unusual for me. Is there any way this fee can be waived? That's it. Sometimes the answer is no. Often it's yes. And every waived fee is more than money saved. It's a domino removed. Another important rule, never finance a small mistake. If you're using high interest credit to fix a short-term problem, you're trading a temporary inconvenience for a permanent expense. A broken appliance, a missed bill, a shortfall at the end of the month. These should hurt once, not compound. If borrowing is unavoidable, make it deliberate and short-term with a clear exit plan, not vague hope, not "I'll figure it out later." Finally, there's the mindset shift that ties everything together. Stop treating small amounts of money as small decisions. $35 isn't dangerous because of the number. It's dangerous because of what it unlocks. Fees unlock interest. Interest unlocks credit damage unlocks worse options. When you see money this way, your behavior changes naturally. You don't panic more, you panic less. Because you're no longer trying to win the whole game, you're just blocking the first move.
In the final part, I want to zoom out and leave you with one idea that reframes all of this. Not as a personal failure, but as a reminder of what actually makes a good financial life. If there's one thing I hope you take away from this, it's this: that 35 mistake didn't keep you broke because you're careless. It kept you broke because the system is designed to magnify small errors made without a buffer. When you have money, mistakes are speed bumps. When you don't, they're trap doors. And once you fall through, everything below gets more expensive, not because you changed, but because the rules did. Understanding that matters. It replaces shame with clarity. It replaces self-blame with strategy. You stop asking, "What's wrong with me?" and you start asking, "Where are the first dominoes in my life?" Because financial stability isn't about never messing up. It's about building your life so small mistakes stay small. A tiny buffer, a few guardrails, the confidence to ask for help instead of disappearing into silence. That's how you protect your future, quietly, consistently, and without trying to be perfect. If this video helped you see your own situation a little more clearly, I hope you'll share it with someone who needs to hear it. And if you want more conversations like this about money, time, and the systems that shape our lives, consider subscribing. My name is John, and I want you to be wealthy in life, not just on paper.